looking forward to having Michael Tanner join us from the Cato Institute, but so far, just like Bruce Upton, we're having a problem with making connections. But I think it's important to maybe share with you some more background before Michael Tanner calls in and joins us here. So let me try to put this in perspective. I'm going to read to you from the Cato Institute's only from their own research here and give you a sense of what's going on there, and then we'll prepare for when Michael Tanner actually calls in. This is his most recent article. Now, what I'm looking forward to is chatting with him about what's new about this, what some of the trends are. But let me share with you Michael Tanner's column. This is his commentary that appeared in the Los Angeles Times late last week. That's what caught our attention. And looking forward to chatting with him about it, just getting his perspective. It is unpacking it even more. So this is Michael Tanner of the Cato Institute, senior fellow there from Los Angeles Times last week. Why get off welfare? Contrary to stereotypes, there's no evidence that people on welfare are lazy. Indeed, surveys of welfare recipients consistently show their desire for a job. But there's also evidence that many are reluctant to accept available employment opportunities. So my understanding is that I think Michael's now joining us. Michael, are you with us? I think we've got Michael. Michael, can you hear me?
This is Toni Turner.
Oh, Toni. I guess I've got the wrong thing here. Toni, my mistake. Toni, welcome to the program, Toni. I don't have you properly introduced in the program because, for whatever reason, I've got the wrong cheat sheet in front of me, and I think that's my mistake. Toni, welcome back to the program.
Thank you, Bill.
It's great to have you here. I know that when we posted our expected interview with you on both Twitter and Facebook, I know that was done properly for today, but it's my mistake that here I'm connecting with you on Monday rather than Tuesday. My mistake. How are you, Toni?
I'm doing real well. How are you, Bill?
I'm doing just fine, thanks. And nothing lost here as we get into the things that you and I have talked about before. I know there's some new trends that you've been talking about on your website, along with the Gainsmaster approach to trading. What's your take right now, Toni, on what's going on with the marketplace? Is this normal in terms of just the season of the market here in August and September? And the idea that trading volume slows down and we become increasingly concerned about what's happening beyond our own borders?
Oh, absolutely, Bill. I've seen many summers in the stock market, and many times the market, because the big institutional traders and investors, many of them, of course, are still in the Hamptons, and
yeah.
So we see the initial burst in the morning, whichever way that goes, and of course we're in an uptrend. Many times the burst is up, and then you can see that people are leaving for the day. They're heading out for the beach or whatever, and the initial burst, and then the market just, if you watch it on an intraday basis, it just, as we say, moves sideways. If you watch the S&P, a lot of times it'll just move sideways. If it doesn't have any other economic news or earnings to look forward to, or even headlines coming in, nothing's happening, then it just calms down, maybe picks up in the last hour before the close.
Yeah. Now, folks, just a little bit more background. We've had Toni on before and love chatting with her about it. She's, with her website and her books out there, she's educating traders and active investors. Often we'll talk about in the program the idea of making the distinction between investors and traders, and we'll talk about that in a moment. But Toni's also the best-selling author of A Beginner's Guide to Day Trading Online. It's in its second edition. And The Beginner's Guide to Short-Term Trading, which is also in its second edition, and Short-Term Trading in the New Stock Markets. Toni, when you talk to investors and you try to assess whether, let's say, which of your materials or advice is appropriate, how do you draw the distinction between someone who should be trading in the stock market versus somebody who should just be sort of like that buy-and-hold investor?
Well, it comes down to everybody's personal objectives. What do they want to achieve? What are they looking for in their financial goals? There are people like me who are very immersed in the stock market who look for different ways to profit from it, mm-hmm. and there are, of course, thousands of ways to go about it. And then there are people who say, hey, I've got a full-time day job. I just want to put my money in the S&P index, and don't bother me, don't talk to me about it. And there's all different ways of doing it. What Gordon and I did in our book that you mentioned, Invest to Win, we're talking to active investors, and those who are people who said, gee, I got into the markets 2007, took me down 50%.
Yep.
And, why did that happen? Where was my broker?
Yeah.
And how can I learn I don't want to be immersed in it. I don't want to watch it every day. But how can I not make those mistakes? Show me where to get out if things don't look good. And that's what we did in our book, Invest to Win. We give you simple signals. Okay, go signal, stop signal, get in when the market does this, get out when it does that. And not even necessarily get out, but maybe choose a different path, like bonds or value stocks.
Yeah. Now, when it comes to trading, when you talk about, that whole idea of get in, get out, as many others like yourself have pointed out in the past, it requires a system so that you're not necessarily reacting with your emotions. There was a book about 3 or 4 years ago I profiled that I thought was borderline ridiculous, that talked about emotions are more important than analysis and systems when it comes to making great investment decisions. I couldn't disagree more, but we had a good argument about that, and I won't disparage the author, but the point is, when you're talking about a program like yours, when emotions start to get involved and you start to either hope too much for a particular stock or become attached to a company and what it does, there are all sorts of emotional reactions that can undermine a more rational and, let's say, strategic decision. How do emotions come into play when you talk about your system for trading?
Well, I think that people think, well, hey, just get rid of your emotions, end of conversation. We are human beings, Bill. We can't. We have had to learn that if you put your hand on the stove, you're going to get burned. And if we didn't know that, of course, we'd be getting burned all the time. I tell traders that our goal, as traders, and certainly investors, is to trade with a feeling of calm confidence. The confidence comes from at least having a basic knowledge of what you're getting into. The confidence comes from having the discipline to have a plan, and it can be a simple plan written on the back of an envelope, but it needs to be a plan. I know where I want to enter this stock, at what price, given the conditions that are in the market, and how this stock is acting itself. I know where my exit is going to be, and you always have to know where you're going to get out should the trade or the investment go against you. It makes no sense to ride it down to goodness knows where.
Yeah.
And that comes in with what you said before, the people who fall in love with the companies, and it's not a good idea. That comes with those kinds of emotions, and that's not a good idea. So know where the best place to get in is, know where to get out, know where you're going to get out, no questions asked, and then if you can, and I can show anyone how to do it easily, look for a profit target. Maybe it's a percentage, maybe it's if you can read charts, the next high point on the chart, where people are going to start to sell. Do you want to take profits there, or do you want to hold it for the longer term? What's your goal? So if you have a plan, then you can trade and invest without the stress that causes really bad mistakes.
When you talk about a sell discipline, and that's one way to phrase what you just described, in your opinion, just draw out data out of thin air without any backing it up, but what percentage of people do you think are involved in the stock market that have little or no sell discipline?
85%.
Yeah, I would agree, give or take. And it's because people do have a feel for what they want to buy and why. They can come up with all sorts of reasons to decide to invest in a particular company or a particular fund or ETF, whatever it may be. But when it comes to knowing, what criteria would drive a sell decision, very few people have thought that through.
Well, they haven't, and I think I know you talked to people in 2007, 2008 that are they were slack-jawed, and it was like I talked to a woman friend of mine having dinner, and she said, well, we don't know when to get out, so of course they sold at the very bottom.
Yeah.
And it's not people's fault. I really don't believe the investing world has gone out and taught people any kind of method. We know, like you said, they know, I love this company, I want to get in, it's going to make me $1 million. But then for whatever reason, the company or the stock market rolls over and starts down, and then they're at a total loss. Well, now what do I do? So they ignore it, and they just don't open their statements anymore.
Yeah.
And that's what I'm trying to teach people. Hey, keep your profits. Don't give them all back. And if you don't know what to do, stand aside.
Yeah. Now, you've got a new DVD series out that talks about ETFs. Apart from knowing, for instance, how and when to buy or sell a particular company on the stock exchange, ETFs offer a very different approach to it all, and probably a little less emotional when it comes to people that will either come up with let's say a non-rational reason for buying or selling a stock. When it comes to ETFs, they're naturally a little less attachable emotionally to something, but it takes a little bit more. I would think it takes a little bit more homework to understand a strategy behind them. What was your motivation for coming up with a DVD series that teaches people how to trade ETFs?
Well, actually, ETFs, many of them, what I'm going to call the traditional ones, the ones that focus on different sectors, for example, and they are equity-driven. They are not driven by currencies, indexes, or commodities. But like the XLF, the Select Sector Spider Financials, that has as its components some of the top financial companies in this country, including the big money center banks, including real estate, and insurance, which of course is part of that sector.
Yes.
And the ETFs give us a natural diversification because they have so many components in them, from a dozen to maybe 200. And so they're naturally diversified, and you don't actually have to know, is Bank of America going to do better than Wells Fargo or U.S. Bancorp?
Yeah.
You just say, I believe the financials are going to go higher here because, and then you can get into an ETF like the XLF or the IYF and the iShares, and you just have to feel that financials are going higher or have done your homework on that. You don't have to do individual stocks. So to the degree that you can do that, then it is diversified and actually has many times, depending on the ETF, it has less volatility to it.
Do you advocate strict index ETFs that have that are known for having extremely low expense ratios, or do you believe that there are some that are either screened or even actively managed that are worth investing through?
Well, the actively managed ones are fine, but investors have to know that that they have higher management fees, percentage-wise. Obviously, they have to pay somebody. So the management fees for that are higher. And if you just go to the fund website, which is what I always recommend, if it's going to be iShares, go to iShares.com. If it's going to be Spiders, go to SpiderIndex.com or just Spiders, SPDRS, or any other fund. And look at the charges that are, and they post them right on there, the management fees.
Yeah.
And they're higher. I think ETFs are fantastic. I do believe that some of the inverse leveraged ETFs that trade in the opposite direction of the underlying index, and they're used as hedges, I believe in the wrong hands, and that's the hands of people who are not experienced and people who don't have the knowledge, as we talked about, to get out when it starts going against them. They don't have the knowledge or the ability to pull the trigger. They are very dangerous in the wrong hands. They are only meant to be used for a day or two.
Yeah. And the mathematics, from what I understand, I've seen studies on this, every one of them consistently showing the same results. The longer you hold on to a leveraged ETF, the more you're going to lose. It's the one place in the stock market where the house is stacked against you. It doesn't mean to be, but it's just the mathematics behind the leveraged ETFs, whereas, so many people look at the stock market like a casino, and they're wrong because the stock market is not, it's an auction market, just like eBay or something else, where basically it's based on supply and demand of a resource. And there are expenses involved, but unlike a casino where the house basically is taking a slice off of everything that happens no matter what, stock market's different. Leveraged ETFs almost act like that, don't they, because of the mathematics behind them?
Well, and the inverse leveraged ETFs, those are the real, as they say, widowmakers.
Yeah.
The ones that go in the opposite direction of the underlying index. Some of the leverage that go in the same direction, they can certainly be used. They don't go against people so much, but the inverse leverage can. And if you just look at them on a chart, most of them just go down all the time.
It's remarkable, and unless you're, like you said, unless you're using it intraday, it can really damage a portfolio. It can damage a portfolio, is right.
And
from that standpoint, most brokerage firms, including the online brokers, they want clients, the account holders, to sign documents that say that they understand these elements. They understand these dynamics before they get involved with them. So there's extra steps to take to make sure that investors are sophisticated enough to handle it.
Well, they need to. They need to.
But when it comes to the actively managed versus the passive or index-based ETFs, you don't necessarily sound like you have a preference as much as you want investors to understand what they're getting into.
They absolutely need to understand what they're getting into, and still in all, these, even if it's an actively managed fund, if it does very well and it outperforms by a percentage point or more each year, then hey, you're still ahead.
Yeah.
As long as it does what it's supposed to live up to.
Yeah. Toni, in addition to the DVD series and your books like Invest to Win, there's also, don't you have a subscription plan, like a club, so to speak, that where you're giving out investment ideas on a regular basis?
We do have a club. We have so much fun, Bill.
It sounds that way.
We do. We have the nicest group of people. We have Tony's Market Club held every Tuesday online. People do need to have a basic ability to read charts to get the most out of it, so they know what I'm talking about. And we go over the market. We look at the market overview, see what the market's doing right now, which side of it we should be on. We have a mini trading lesson, which I explain about the markets and how they work, and sometimes they're trading strategies, or I do a wide variety of lessons. And then I actually give them 5 stocks or ETFs, and if they could turn into high potential trades, what their entry, stop, and profit targets would be on those. And then I send out an update 2 days later explaining everything that's happened so far.
Okay, so in other words, it's not just, is a sort of a live conference call format or webinar once a week, and then you have follow-up emails?
Yes, it's a live webinar I'm on, and people can chat. There's a chat box. They can talk to me and ask questions.
Okay, so they can interact with you and get your perspective on things.
Absolutely.
Well, that's terrific. Again, listeners, Toni is the co-author of Invest to Win, Earn and Keep Profits in Bull and Bear Markets with the Gains Master Approach, along with Gordon Scott. And as I mentioned, you can learn an awful lot more about that by not just going to the book, but going to Toni Turner's website, ToniTurner.com. It's TONI Turner.com. Toni, again, so appreciate your time, and congratulations again on all these resources, and thank you for joining us today.
Well, thank you for inviting me, Bill. I appreciate it.
Thanks. It's been my pleasure. Listeners, stick around for the Bloomberg radio update coming up, Bloomberg News coming up at the top of the hour. I'm Bill Kearney. This has been Financial Spectrum. We will be back tomorrow.